Hello everybody, I hope you are doing super amazing. Welcome back to the first episode of CMA Final Fast Track Revision Batch for Corporate and Economic Laws. I'm super excited to see you all people. Yes, people, let me tell you one thing. We are not here just to pass the exams, but we are here to score an exemption or score marks equivalent to All India rank. We are not here just to pass the exams, but to score an exemption or All India rank, not less than that. Okay, logically speaking people, to score an exemption, students face three major problems. Number one is people understanding concepts. Okay, number two problem is learning. Number three is writing. Now the important question is, how am I going to solve these three problems for you? Number one, conceptual clarity. If you see my notes, I have simplified the notes in such a manner that whatever you read, you will be able to understand it quickly. Okay, whatever you read, you will be able to understand it quickly. I have also included lots of case studies and examples so that your conceptual clarity will become a lot better. Number one. Number two is people learning. Due to vast syllabus of CMA final, students are not able to revise and learn on time. So what we are going to do now is, we are going to study using mind maps. If you study from mind maps, you will understand how mind maps works. When you start this lecture, mind maps help you read, understand, learn the concepts 10 times faster compared to how you were studying earlier. This will improve your quality of studying. This will also improve the speed of your studying by 10 times. Okay. Number three is people writing. After we complete every single chapter in this fast track revision batch, what we are going to do is, we are going to discuss the questions asked in the past year's question papers. At least we'll make sure we will solve at least 5 years question paper after we complete every single chapter. With this people, by the end of completing this fast track batch, your reading will be done, your learning will be done, your writing will also be done. Okay, cool. Now the important question is, how am I going to conduct this fast track batch? Okay, how am I going to conduct this fast track batch? People, I want you to keep my notes along with you when you watch my video. What I want you to do is, whenever I teach any concept using mind map, I want you to pause the video, read the notes once before you watch my video, and then play this video whenever I teach any concepts. With this, your reading will also be done, your understanding part will also be done. Okay, I am also assuming there are two types of students watching this lectures. Number one are those who have already studied corporate and economic laws and then they are watching this for the revision purpose. And second category students are those who have not studied this corporate and economic law even once and then they are watching this fast track revision batch. I want the second category of students to please pause this video, go to my regular videos, YouTube videos, watch my lectures and then come to the fast track revision videos. The reason is, in my regular videos, I have explained every single concept as detailed as possible so that you will not feel as if you are mugging up concepts or just by-hearting the concepts. Okay, it's really boring. I want you to understand the concepts in the best way possible and then come to this revision batch. Cool? Alright people, alright. So let's get started people. The first chapter that we are going to study is Raising Finance from Capital Markets. Raising Finance from Capital Markets, a part of Sebi regulations chapter that will become in the exam for 10 marks. Okay, this is the sub chapter of the main chapter, that is Sebi regulations. Cool? Perfect people, perfect. So people, in this video we are going to study 7 topics to cover raising capital from. Hello, am I audible? Yes. People, we are going to study 7 topics in this chapter of raising finance from capital markets. Okay, what are those 7 topics? Eligibility of issuer, who are the intermediaries, appointment of intermediaries, conditions for IPO, pricing of shares, promoters contribution and allocation of shares in IPO. If we are done with the 7 topics, that's it. We are done with raising finance from capital markets. Clear? Yes people, yes. Let's get started. Alright people, alright. People, this is the mind map. I hope you are able to see it. Yes. The first concept that we are going to study is, people, eligibility of issuer. Quickly we will understand. First point is the issuer, promoter, director. Over here, this is company, this is promoter, this is director, this is selling shareholder. So, company, promoter, director or selling shareholder should not be debarred by SEBI, or he should not be involved with companies who are debarred by SEBI from accessing the capital markets. The first point is the issuer, promoter, director or the selling shareholder should not be debarred by SEBI or should not be involved with companies who are debarred by SEBI from accessing the capital markets. Debarred means prevented or prohibited from accessing capital markets. Clear, people? The first point is no debarred by SEBI. The promoter, company, issuer, director or the selling shareholder should not be debarred by SEBI or be involved with companies who are debarred by SEBI from accessing the capital markets. Clear? Perfect. The selling shareholder concept I will teach you in the next concept. Okay, just mark it, selling shareholder. Okay, perfect, people, perfect. So the first point is the company, promoter, director or the selling shareholder should not be debarred by SEBI. Perfect. Next is, we will read first red points. Okay, the points that are marked in red, we will read that first. Next, company, promoter, director should not be declared as a willful defaulter. Willful defaulter means who have defaulted in the repayment of loans, whether it is interest or principal. Okay, promoter, director, issuer should not be a willful defaulter. Clear? Perfect. Next we will read the purple points. Okay, purple points. Purple points is, number one, you have to make an agreement with the depository. If I am Lenskart, I want to go for an IPO. I want my shares to be listed on NSE and BSE. I will make an agreement with the depository so that my physical shares are converted into electronic shares. Okay, because electronic shares helps you to deal with the shares in the easiest way possible. So purple point says you have to make an agreement with the depository. Depository can be NSDL or CDSL. Next is, promoters holding should be in demat form. Before Lenskart is going for an IPO, it should ensure that its promoters shares are held in demat form. Okay, till here we understood 2 points of default, 2 points of default and 2 points for demat. 2 points for default, 2 points for demat. Number one was the promoter, director, issuer or the selling shareholder should not be debarred by SEBI or be involved with the companies who are debarred by SEBI from accessing the capital markets. Number one done. Number two is the promoter, director, issuer should not be categorized as a willful defaulter by or any bank. Okay, 2 points for default over, 2 points for demat. Okay, number one was agreement should be made with the depository to convert physical shares into electronic shares. Agreement should be made with the depository. Depository can be NSDL or CDSL to convert the physical shares into electronic shares. Demat 1 point over. Another point for demat is promoter's shares should be held in demat form. Clear? So two points related to default, 2 points related to demat. Now 3 very easy points. What are those easy points? Blue ones. Before Lenskart goes for an IPO, it should ensure that it has no partly paid up shares. Before Lenskart goes for an IPO, it should ensure that there are no partly paid up shares. All the shares should be fully paid up. Either you convert the partly paid up shares to fully paid up or you forfeit, cancel those partly paid up shares before you go for an IPO. Okay, easy points. Number one is no partly paid up shares. Cool. Next, stock exchange approval. Now people, if Lenskart is listing its shares in the stock exchange, if Lenskart is listing its shares on stock exchange, it should first have approval of the stock exchange. Right or wrong? Logically speaking, very logical. If I am listing my shares in a market, first I should get an approval from the market to list my shares. Cool. So 2 points, very easy. No partly paid up shares. Second is stock exchange approval. Okay, among those, for example, Lenskart, if it wants to list its shares on NSE and BSE, it should choose one as the designated stock exchange. Designated stock exchange means who will be coordinating activities, who will be handling the regulatory compliance and all sorts of things. Okay, so number one, stock exchange approval. One stock exchange should be appointed as a designated stock exchange. Number two is no partly paid up shares. Okay, the next easy point is, blue ones are very easy points. Okay, the IPO issue period should be minimum 3 days and maximum 10 days. IPO issue period should be minimum 3 days and maximum 10 days. After 10 days, the IPO window closes. Clear? So, 3 easy points. Number 1 is IPO issue period 3 to 10 days. Number 2 is no partly paid up shares. Number 1 is stock exchange approval should be obtained. Clear? Next, people quickly will revise whatever we have learned in the 3 colors. 3 easy ones we understood right now. 2 default related, you should not be a willful defaulter. Promoter, director, issuer should not be debarred by Sebi or involved with companies debarred by Sebi from accessing the capital markets. Capital markets means stock exchange. Okay. 2 default rated over, not 2 demat. Promoter's share should be held in demat form. Number 1, okay. Number 2 is agreement with the depository, NSDL or CDSL. Because it's listing its shares on NSE and BSE, the shares will be dealt by the depository. So depository will be dealing in demat electronic shares. So it should ensure that the shares are in electronic form so that it is a matter of convenience. Okay. Next is 3 difficult points. 3 difficult points. Now easy difficult is minimum subscription should be 90%. For example, if Lenskart wants 1000 crores from the public, Lenskart is launching an IPO for 1000 crores from the public, it should ensure that at least 900 crores subscription are done. It should ensure that 900 crores have been subscribed. If not, entire money should be refunded to the investors. So minimum 90% of the issue should be subscribed. Okay, number 1 is okay. Next, limit on general corporate purpose. For example, Lenskart is raising 1000 crores from an IPO. Lenskart is raising 1000 crores from an IPO. It wants to expand itself. It wants to expand. It wants to open 10,000 new stores all over India. Lenskart wants to open 10,000 new stores all over India. That is the reason why it wants 1000 crores. Now people, the details about how the money will be utilized is there in the offer document. Offer document also we will understand it. Okay. Basically, it's a document where all the details of the IPO are mentioned. Now, this 1000 crores should not be entirely used in expansion plan. There may be some expenses like administrative expenses, working capital expenses, day-to-day business operation expenses that we did not presume that we are going to incur those expenses. So Sebi says if you are raising 1000 crores, you can maximum allot 250 crores for general corporate purposes, not more than that. Remaining 750 crores you have to use it 100% for the activities that you have mentioned in the offer document. Clear? So if Lenskart is raising 1000 crores, not more than 250 crores can be utilized for general corporate purposes, administrating activities, day-to-day business operations, working capital requirements. Such type of expenses can be used. Okay. Remaining 750 crores it has to use for expansion projects. Clear? So there is a limit on general corporate purpose, that is maximum 25%. Okay. Perfect. Now comes the main point. Firm arrangements for 75% funds. Okay. Let's understand this. People assume Lenskart requires 1000 crores for expansion. Lenskart requires 1000 crores to open 10,000 new stores all over India. Now, among these 1000 crores people, Lenskart already has 200 crores with it in the bank account. Lenskart already has 200 crores in the bank account. Okay. 100 crore loan is going to take. Okay. 100 crores is going to take a loan. 200 crores already it has a bank account. And remaining 700 crores it's going to raise from IPO. Clear? Lenskart requires 1000 crores. That this is the project finance. Project finance. Okay. So project finance is 1000 crores to open 10,000 new stores all over India. Now Lenskart already has 200 crores in its bank account. This will be called as internal accrual. The money the company already has with itself. Okay. Next, 100 crores going to take a loan and remaining 700 crores it is going to take from an IPO. Now, this clause is saying that the project finance, that is 1000 crores minus bank 200 crores plus IPO is 900 crores. So 100 crores is remaining. So firm arrangements should be made for financing these 75% of 100 crores. Whether it can be venture capital fund, whether it can be private equity funds. So what it's saying is, company should not be completely dependent on IPO to raise funds. Company should not be entirely dependent on IPO to raise funds. Okay, it should have a backup. 75% of project finance, 75% of project finance excluding internal accruals and IPO proceeds. 75% of project finance excluding internal accruals and IPO proceeds should have firm arrangements. Okay, the firm arrangement should be made for 75% of funds from either private equity funds or it can be venture capital funds. Clear? This is a very difficult part of this concept. Okay, perfect. Now let's revise it. Number one. Okay, now two default related, issuer, promoter, director or selling shareholder should not be debarred by Sebi or should not be involved with companies debarred by Sebi from accessing the capital markets. 1 point over. Next point is, the issuer, promoter, director should not be a willful defaulter by any bank. Okay. Now, two demat related. Promoters' shares should be held in demat form. Okay. Number two, if I want my shares to be listed on stock exchange, I should have it dematerialized form, demat form. So I have to make an agreement with the depository, NSDL or CDSL, to have my shares in demat form. Okay. Two demat related points over. Next is 3 easy. 3 easy is IPO period should be minimum 3 days, maximum 10 days. Okay. Number two is, if I am listing my shares on stock exchange, obviously I should have approval from the stock exchange. Correct? One appointed as designated stock exchange to coordinate all the activities. Okay. Number two. Number three is, shares should be fully paid up. There should not be partly paid up shares. If there are any partly paid up shares, either it should be forfeited or it should be converted into fully paid up shares. Clear? Now three difficult. One is minimum 90% subscription should be done. If not, all the money should be refunded. Okay. Number two is, general corporate purpose limit should not exceed maximum 25%. Okay, good to go. And then last is, you should have firm arrangements for 75% of project finance excluding IPO proceeds plus internal accruals. Clear, people? Perfect. People, let me tell you one thing. This is easy. Sorry. This is difficult. Very difficult. After this, these three topics are super easy. Okay. These topics are super easy. Cool. So our goal is to complete quickly till here, and then it will be a cakewalk. Remaining three will be cakewalk for us. Alright? Perfect. Now, the next concept is, who are the intermediaries? Okay, before Lenskart and the public, who all will be involved? Let's understand it. Number one is, people, merchant banker. Okay, Merchant banker is the main guide of the entire IPO process. Number one. Number two is what he does. He prepares documents. He sets the share price. Number three, he ensures that IPO reaches the investors. Okay. He prepares documents. He sets the price of shares. Number three, he ensures the shares reaches the investors. Okay. He is the main guide of IPO. Number one. Number two, he prepares document. Number three, he sets the pricing of shares. And number four, he ensures the shares reaches the investors. Clear? So quickly we read, people. So quickly we read. See, this is how we should study using mind maps. This will increase your speed by nearly 10 times. Okay? Perfect. Next, registrar. Registrar is basically the administrator of shares. Registrar is basically the administrator of shares. He handles all requests from people who want to buy shares. Registrar handles all requests from the people who want to buy shares. Number two, he ensures that everyone gets the right amount of shares and keeps track of applications. Number two, he keeps track of applications. Number two, he ensures that everyone gets right amount of shares. And the last is he handles all requests from people who want to buy shares. Perfect, easy to go. Next, underwriters. People, let's say Lenskart wants to raise 1000 crores. 900 crores have been subscribed. Remaining 100 crores have not subscribed. Over here, the underwriter will come and tell Lenskart that, bro, we will make an agreement. Tomorrow, if any shares are not sold in the market, the leftover shares, I will purchase it from you. Tomorrow, if there are any leftover shares after the IPO, I will purchase it from you. Cool. He ensures that all the shares are subscribed. Cool. Let's see this. Underwriters are guarantee providers in IPO. Guarantee providers means if they do not purchase your shares, I will purchase your shares. Guarantee providers. Number two, he promises to buy leftover of shares. He promises to buy leftover shares that are not sold in the market. He promises to purchase leftover of shares that are not sold in the market. Clear? Next, banker to the issue. Banker to the issue handle with all the money related transactions. Banker to the issue handle all the transactions that are related to money. He ensures that he is responsible for receiving money from the investors. He is responsible for receiving money from the investors who want to buy shares in IPO, obvious. Number two, once the IPO is done, the money that it receives, it is transferred to Lenskart again. Clear? Again, banker to the issue, it handles all the transactions related to money. Number one, he is responsible for receiving money from people who want to buy shares in an IPO. Okay. Number two, once the IPO is done, all the money is transferred to Lenskart company. Clear? Perfect. Now let's understand another person who is compliance officer. Compliance officer. He is responsible for monitoring the compliance with this securities law. He ensures that the intermediaries, the issuer and all the persons involved in the IPO process are complying with the rules and regulations set by Sebi. For example, let's say 75% of project finance should have form arrangements excluding internal accruals or IPO proceeds. So this will be monitored by a compliance officer to see if everything is going right or not. Okay. Next is he also addresses the investors' complaints. Cool. Compliance officer, number one, monitoring compliance with the securities law. Number two, addresses investors' complaint. Clear? Next is syndicate members. Syndicate members help with the book building process. People, basically, if an issuer wants to fix price on shares which public will be purchasing from it, there are two types of identifying the price. Number one is either you give fixed price. Let's say I am issuing 1 lakh shares at rupees 100 each, fixed price. Or number two, if I don't know what my price will be, what I will do is I will give a price range like 80 to 150. Between these 80 to 150, people will bid and the price will be determined based on the demand. We will understand this book building process. Okay. For now, let's understand this syndicate members. Okay. Syndicate members help with the book building process. They allocate all the shares. They are responsible for allocating all the shares at the maximum price. Book building method is basically finding out the maximum price, at which all the shares will be subscribed. Finding out the maximum price at which all the shares will be subscribed. So this process will be assisted by syndicate members. Clear? Next is, he also assists in distributing the shares plus ensuring everything runs smoothly. He also assists in distributing the shares plus ensures everything runs very smoothly. Cool? Now let's understand the book building process. People, tell me one thing. Lenskart wants to sell 5,000 shares at maximum price. Lenskart wants to sell 5,000 shares. Now we are required to find out the price, which is beneficial for Lenskart also and which is beneficial for shareholders also. Let's find out. Imagine A, B, C, D, E, F, G. These people have submitted the bids. Okay, Lenskart says that the price range for my shares should be between 100 to 500. That means whoever wants to purchase the shares, they have to submit the bid between rupees 100 to 500 rupees. Cool. Now A to G, A, B, C, D, E, F, G. 7 people have submitted their bids. A says, I will purchase 2,000 shares at rupees 100. I will purchase 2,000 shares at rupees 100. B says, I will purchase 3,000 shares at rupees 150. C says 1,000 shares I will subscribe at rupees 500. D says I will purchase 1,000 shares at rupees 200. E says 2,000 shares at rupees 300. F says 1,000 rupees at 400. G says 6,000 shares at rupees 150. Now you tell me, people. Now you tell me, you have received 1, 2, 3, 4, 5, 6, 7. You have received 7 bids, but you only have 5,000 shares to sell. Whom will you sell the shares and at what price? Tell me. Obviously, people, the ones who have submitted the highest bids will first find out. Highest bid was submitted by C for 500 rupees, D for 200 rupees, E for 300 rupees and F for 400 rupees. Now, these people will get the shares. That is clear. C will get the shares, D will get the shares, E will get the shares, F will get the shares because they have submitted the highest price for the bids. Now, the important question is, how are we going to determine the price? How are we going to determine the price? Let's see. Now, people, you tell me, what will be the price at which all the 4 people will sell their shares? What will be the maximum price at which C will also sell my shares, C will also purchase the shares, D will also purchase the shares, E will also purchase the shares, F will also purchase the shares. Now, don't you think this is the price? If C is willing to pay 500 rupees, don't you think he can pay 200 rupees? Obviously, yes. If D wants to pay 200 rupees, he is going to pay 200 rupees. E wants to pay 300 rupees, but he can pay 200 rupees. F can also pay 200 rupees, correct? So the price will be, people, 200 rupees. So C, D, E and F will get the shares at rupees 200. Clear? This is how price is identified using book building method. Allotting all the shares at maximum price. Clear? First, what we did was, first we find out who are submitting the highest bids. C is submitting 500 rupees, 1,000 shares is submitting, now remaining 4,000 shares are remaining. D wants to purchase 1,000 shares at rupees 200, okay, 3,000 shares are remaining. Next is E wants to purchase 2,000 shares at rupees 300, 1,000 shares are remaining. F can purchase 1,000 shares, remaining, done. So they will not receive the shares, he will not receive the shares, he will not receive the shares because they submitted low pricing bids. Clear? This is called as book building process. Perfect, perfect. Now, next, third topic that we are going to understand is appointment of intermediaries. Now we understood the roles and responsibilities of intermediaries. Now we will understand how is the appointment is done of intermediaries. Okay. Number one is merchant banker. Okay. People tell me one thing. If the IPO size is like 10,000 crores or 20,000 crores, there will be lots of work to do. That cannot be handled by a single merchant banker. So what company does is, company appoints 2 to 3 merchant bankers. Among those, one should be appointed as lead merchant banker. One will be appointed as lead merchant banker. Okay. So what will be the roles and responsibilities of lead merchant banker? He will be the main point of contact between all the merchant bankers and the issuer, number one. Number two, he manages the overall process. For example, work will be distributed to different merchant bankers and he will manage overall process of IPO. Next is he coordinates activities of other merchant banks. Clear? Issuer must appoint one or more merchant bank to manage IPO. At least one of them should be the lead merchant banker who will coordinate the activities of other merchant banks, who will manage the overall IPO process. And the last is he will be the main point of contact between all the merchant banks and the issuer. Clear? Perfect, people, perfect. Next is syndicate members. Syndicate members who will be only and only appointed when price is identified using book building process. We understood over here, people, syndicate members help with the book building process. So there are two types of pricing I told you. Number one is fixed pricing, number two is book building method. So if there is fixed pricing method, syndicate member will not be appointed. If there is a book building method, syndicate member will be appointed. Next is bankers to the issue. Bankers to the issue, they ensure that investors across the country can apply. Investors across the country are able to apply for the IPO. Investors all across the country are able to apply for an IPO. This, their duty, their responsibility is to increase the participation of all the investors plus increase the demand for shares. Basically, people, they help reach more people so that the subscription will improve, and at the same time bankers will also make sure people feel easier to invest in the companies. Clear? Again, bankers to the issue ensure that the investors across the country are able to apply for an IPO. Their duty is to increase the participation of people plus increase the demand. At the same time, they ensure that the subscription is also increased and it is easier for people to invest in. There is no difficulty for people to subscribe for shares of Lenskart. Clear? Next is compliance officer, we know, and registrar to the issue, we already know their roles and responsibilities. Okay. Clear, people? We are done with the appointment of intermediaries. Okay. People, in half an hour, we are done with 3 difficult topics. Okay. Now, how many difficult topics are remaining? 1 very difficult topic is remaining, and then after that, everything will be super easy. Conditions for IPO is little tricky, little difficult, but don't worry, I am there, people. You don't have to worry at all. You just watch. Okay. Whenever I teach any concept, pause my video, read from my notes first, and then come to my conceptual explanation. Clear? Perfect, people, perfect. I hope you are with me. All right, people. All right. Yes. Next is the main part, conditions for an IPO. People, when we understood eligibility for an IPO, we understood who can think of an IPO. Lenskart wants to become a cost accountant. Lenskart wants to become a cost accountant. First, it has to clear CMA foundation. Okay. After it clears CMA foundation, it has to clear CMA inter, correct? And that CMA inter is that eligibility of issuer. Once he clears CMA inter, and then is the final conditions for IPO. Once he clears this final step, he will be done with the IPO and his shares will be listed. So he needs to pass through two set of conditions. Number one is CM enter eligibility for of an issuer. Number two is conditions for an IPO. Clear? Then only he will become a cost accountant. Basically, lens card, eligibility, next is conditions. After he clears this, his shares will be listed. Okay, perfect, perfect. All right. This is the creamiest, sweetest part of this chapter. Okay, if you are done with this, we are done with this chapter, people. This is the very important concept in this chapter. Okay, perfect, people, perfect. Okay, let's start. People, for a company that is unlisted, if it wants to be listed, an unlisted company which wants to get itself listed, what are the four conditions it has to comply with? For an unlisted company which wants to get listed, what are the four conditions that it has to comply? Let's understand that. Number one condition is net tangible assets should be more than or equal to 3 crore rupees. Net tangible assets should be more than 3 crore rupees in the each preceding 3 financial year. Net tangible assets should be minimum 3 crores in each of the preceding 3 financial year. For example, today is 2025, correct? 2024, 2023, 2022. In each of these financial years, the net tangible assets should be at least 3 crores in each of the preceding 3 financial year. In 2024, 3 crores, 23, 3 crores, 22, 3 crores, at least 3 crores, okay, not less than that. Clear? Now, there is one more condition to that. Net tangible assets, among those net tangible assets, let's say Lenskart has got net tangible assets of 10 crore rupees. Lenskart has got a net tangible assets of 10 crore rupees. Now, not less than 50% should be held in. Hello. Am I audible? Yes, people. Yes. People, supposing Lenskart wants. People, let's say Lenskart has got 10 crores net tangible assets. Lenskart has got 10 crores net tangible assets. Now, it should not have more than 50% of the net tangible assets in the monetary form. It should not have more than 50% of the 50% net tangible assets in monetary form. For example, if Lenskart has 10 crores as net tangible assets, it should not have 6 crores in monetary form. No, it should not have more than 5 crores in monetary form. Okay, net tangible assets not more than 50% should be held in monetary form. If there is more, if the net tangible assets, if more than 50% of net tangible assets is there in monetary form, it has to submit a document to SEBI regarding how they will be utilizing the money. Okay, it has to submit a document related to how they are going to utilize this money. Firm commitment they have to give to SEBI. How are they going to use the money? Okay, let's understand the logic behind it. Okay, let's understand the logic behind it. So tell me one thing: if Lenskart already has got, suppose say Lenskart has got 10 crores as net tangible assets, already more than 50% has got in monetary form. Already it has got more than 50% in monetary form. Why do you think they will utilize the money properly? If they already got so much money, Why are they not utilizing this money? That doubt will come to the mind of Sebi. Okay, if they have already got so much money, why are they not utilizing this money? Okay, why are you going for an IPO? Okay, supposing if less than 50% monetary form, okay bro, no problem. If more than 50% is there in monetary form, they have to submit to Sebi a firm commitment as to how are they going to utilize the excess money. Clear? First condition is net tangible assets should be at least 3 crores in the preceding 3 financial years. Among those, not more than 50% should be held in monetary form. If more than 50% is held in monetary form, it has to give a document. It has to submit an undertaking as to how are they going to utilize the excess money. Clear? Now people, tell me one thing. There is a concept called as offer for sale. There is a concept called as offer for sale. For example, let's say Reliance Industries has got 3 shareholders. Reliance Industries has got 3 shareholders. Number 1 is Mukesh Ambani, who is holding 500 shares. Mukesh Ambani, who is holding 500 shares. Anant Ambani, who is holding 500 shares. Bill Gates, who is holding 200 shares. Reliance Industries has got 3 shareholders. Number 1, Mukesh Ambani, 500 shares. Anant Ambani, 500 shares. Bill Gates, 200 shares. Now, Reliance is not listed on stock exchange. Let's assume Reliance is a private limited company. It has not listed in stock exchange. Now people, Bill Gates wants to sell his shares now. Bill Gates says, bro, I am done with your company. Now I want to cash my shares. I want money. You take my shares. I want to sell my shares. You give me money. Bill Gates wants money. Mukesh Ambani, since a long period of time, he wants his shares to be given to public. Mukesh Ambani wants his shares to be given to the public. Bill Gates wants to sell his shares. Bill Gates wants to sell his shares to the public. Clear? Now, again we will discuss. Mukesh Ambani has got 500 shares. Anant Ambani has got 500 shares. Bill Gates has got 200 shares. Bill Gates wants to sell his shares. Mukesh Ambani wants Reliance to be a public limited company. Mukesh Ambani wants his company Reliance to be held with the public. Okay, he wants to list his shares on a stock exchange. Now people, what Mukesh Ambani will tell Bill Gates is that, Bill Gates, you want to sell your shares? Okay, I want my company to become a public limited company so that everybody will trade my shares. Now, Bill Gates, why don't you do one thing? You sell your shares to the public. Public will give you money. You will receive money. You are happy. Public will get their shares. I am happy because my shares are held with the public now. Okay. Again, I will tell you. Bill Gates, what does he want? He wants to sell his shares. Mukesh Ambani wants his shares to be held with public. Correct? Now, what Mukesh Ambani will tell Bill Gates is that instead of Reliance Industries issuing new shares to the public, why don't you do one thing? You sell your shares to the public. You will get your money. You are sorted. Public will get our shares. Public is sorted. And I am also sorted because my shares are held with the public. This is called as offer for sale. This is called as offer for sale. Again, I will tell you. Bill Gates wants to sell his shares. Doesn't matter if it is me or it is public. He wants money basically. I want my shares to be held by the public. I want my shares to be held by the public. Public wants my shares from Reliance Industries shares. So what I will do is I will ask Bill Gates, bro, you sell your 200 shares to the public. Public will pay you money. You are sorted. I am sorted because my shares are now with the public. Cool, good to go. Now people tell me, in this transaction, is Mukesh Ambani getting any monetary benefit? Is Mukesh Ambani getting any monetary benefit? Bill Gates sold his shares to the public. Public paid him money. I am not receiving any monetary benefit. I am Mukesh Ambani. I am not receiving any monetary benefit. So if there is no monetary benefit, this process is called as offer for sale. Okay, offering shares for sale. Offering shares for sale. I am not creating new shares. I am offering the existing shares of Reliance Industries that Bill Gates has to the public. Now people, is Mukesh Ambani getting any monetary benefit? No. If Mukesh Ambani is not getting any monetary benefit, You tell me, is he required to follow the monetary form condition? 50% should be held in monetary form? No. Okay, no. Because if I'm not getting any monetary benefit, I'm not required to follow this condition. Simple. So people, again I will tell you, first condition is net tangible assets should be at least 3 crores in each preceding 3 financial year. Clear? Among those net tangible assets, not more than 50% should be held in monetary form. Not more than 50% should be held in monetary form. If more than 50% is held in monetary form, the issuer has to give a firm commitment to SEBI regarding how are they going to utilize the money. Now this 50% condition is not applicable if IPO is through offer for sale. This 50% condition is not applicable if IPO is through offer for sale. Now what is the meaning of offer for sale? You know it. Reliance Industries, 3 shareholders, Mukesh Ambani, Anant Ambani, Bill Gates. Bill Gates wants to sell his shares. I want the Reliance shares to be held by the public. So what I will tell is, I will tell Bill Gates to sell the shares to the public. Public will get the shares. Bill Gates will get money. My objective is achieved, that my shares are now public. Bill Gates' objective is achieved. He has got his money. Public's objective is achieved because they have got in Reliance Industries shares. Clear? Good to go? Perfect. Perfect. Next. The second condition is minimum average pre-tax operating profit should be 15 CR in preceding 3 out of 5 financial year. Okay. Operating profit, that operating profit that does not includes taxes, that does not include interest. Okay. Basically, it's people you have studied, right? EBIT minus interest, taxes minus profit. I will tell you one thing. Quickly I will tell you. That operating profit where interest and taxes are not included. Okay? Are not deducted. So pre-tax average operating profit means operating profit without deducting interest, without deducting taxes is called as pre-tax average operating profit. So what this condition is saying, that minimum pre-tax average operating profit of 5 years should be 15 CR in preceding 3 financial years. Let's understand this in an example. Okay, quickly we'll understand this. Pre-tax average operating profit. Let's say in 2025 I want to go for an IPO. In 2025 I want to go for an IPO. Last year's pre-tax average operating profit was 18 CR. 2023 average operating profit was 10 CR. 2022 average operating profit was 15 CR. 2021 12 CR. 2020 16 CR. Now in the last 5 years, which are the 3 most profitable years? In the last 5 years, which are the 3 most profitable years? Tell me. 18 CR, 15 CR, 16 CR is profitable. Now, if I do an average, 18 plus 15 plus 16 divided by 3, obviously it will be more than 15, correct? Obviously it will be more than 15. So what it's saying is, in the preceding 5 years, the 3 most profitable years average should be more than 15 CR. The 3 most profitable years average should be 15 CR. Cool? So minimum pre-tax average operating profit in the last 3 out of 5 financial years should be minimum 15 CR. Okay, in the last preceding 3 out of 5 financial years, the average should be at least 15 CR. Cool. Next is net worth. Net worth should be at least 1 CR in last preceding 3 financial years. Net worth should be 1 CR in the last 3 preceding financial years. So net worth should be 1 CR in 2024, in 2023 it is 2 CR, in 2022 it is 1.5 CR. It is more than 1 CR in each of the preceding 3 financial years. That means you have complied with. Okay. So 3 conditions we have learned till now. 3 conditions we have learned till now. Number 1 is net tangible assets should be at least 3 CR in preceding 3 financial years. Among those net tangible assets, not more than 50% should be held in monetary form. If more than 50% is held in monetary form, they have to give a firm commitment to Sebi regarding how are they going to utilize the money. Now this 50% condition is not applicable when offer for sale is there, when shares are issued through offer for sale basis. First condition over. Second condition is pre-tax average operating profit in the preceding last 3 out of 5 financial year, in the preceding 3 out of 5 financial year should be at least 15 CR. Okay. Third is net worth. Net worth should be at least 1 crore in the preceding 3 in each of the preceding 3 financial years. Clear? Perfect. Number 4, name change. People, what this rule is saying that if I have changed my name in the last 12 months, if I have changed my name in the last 12 months, then the total revenue that I have earned in the last 12 months, more than 50% of this total revenue should be from a new name. More than 50% of this total revenue from a new name. Let's understand this. Let's say I want to go for an IPO on 1st March 25. In the last 12 months, I have changed my name. So what it's saying is, if I have earned a revenue over the last 12 months of 100 crores, more than 50 crores, the revenue I should have earned from the new name. More than at least 50 CR should be from the new name. Clear, people? Basically, very clear. If you want to understand this, why this is happening, why that is happening in detail, you have to watch my regular lectures. Okay? Perfect, perfect. Yes. So 4 conditions. Number 1 is net tangible assets should be at least 3 CR in each preceding 3 financial years. Okay. Number 2, minimum pre-tax average operating profit in the last 3 out of 5 financial years should be 15 CR. Number 3, net worth should be at least 1 CR in each preceding 3 financial years. And last is, if you have changed your name in the last 12 months, at least 50% of revenue should be earned from the new name. Clear? Life is sorted. Perfect. If you follow these 4 conditions, your company will be eligible for getting listed. Your company Lenskart will be eligible for getting listed. Clear, people? Are you having fun, people? We're understanding every single thing logically as far as possible. Okay. The reason is we don't have time to understand every single thing in detail, people. So for that you have to watch my regular lectures. Okay. This being a faster revision batch, I am fast forwarding it. Okay. Perfect, people. Perfect. 4 conditions we have understood. Now comes the main part. People, if Lenskart does not follow these 4 conditions, still it can go for an IPO provided if it is raising 1000 crores, at least 750 crores should be subscribed by qualified institutional buyers. 75 crores should be subscribed by qualified institutional buyers. Now, qualified institutional buyers are super big players, banks, financial institutions, portfolio management companies, okay, LIC corporation, insurance companies, SBI. Such big players are called as qualified institutional buyer. If you are able to convince such big players to subscribe at least 75% of your net offer, that means you are genuine company. You are a genuine company, even though you are not eligible, but still you are a genuine company. This is what it proves. Okay. So what it says is, even if the company does not follow these 4 conditions, still there is an alternative route. Still there is an alternate route whereby 75% of the net offer should be subscribed by qualified institutional buyer, plus the price at which you will allot the shares to qualified institutional buyer, that price should be discovered through book building method. That price should be set using book building process. If still company fails to qualify these two conditions, it has to refund all the subscription money that it has received within 15 days. Sorted, people? All clear? All clear? Perfect, perfect, perfect. People, I will tell you one more thing, okay? When calculating this pre-tax operating profit, when calculating pre-tax average operating profit, you have to comply with two conditions. Number one is, it should be a restated figure. The profit that you have calculated, the end profit that you have calculated, that end profit should be a restated. It should not have any valuation error. It should not have any defects. It should be very accurate. Number one, it is very obvious. Number two is, it should be on consolidation basis. Consolidation basis means, if Lenskart is a parent company, all its subsidiary companies' financial results should also reflect the financials Lenskart is showing. Meaning, consolidated means the final figure it is showing, the final pre-tax operating figure should also include subsidiary companies' financial results. Okay? Perfect? Yes, people, yes. So these are the four conditions. Again, quickly, for the last time we will revise. Number one is, net tangible assets should be at least 3 crores in the preceding 3 financial years. Among those net tangible assets, not more than 50% should be held in monetary form. If more than 50% is held in monetary form, you have to give a firm commitment to Sebi regarding how are you going to utilize the money. Life is sorted. Now this 50% criteria is not applicable when shares are issued through offer for sale basis. Number two is, pre-tax average operating profit should be at least 15 CR in preceding 3 out of 5 financial years, and this pre-tax operating profit should follow two conditions. Number one, it should be restated, meaning it should not have any defects. Number two is, it should be consolidated basis. The subsidiary company's financial results should also be taken into consideration. 2 over 3 is net worth. At least one, the net worth should be at least 1 CR in preceding 3 financial years. Okay, sorted. Number 4 is name change. If the company has changed its name in the last 12 months, the total revenue earned from the last 12 months, more than 50% of the total revenue should be from a new name. Okay. Now, if the company does not follow these 4 conditions, still it can go for an IPO, provided 75% of the net offer is subscribed by big player, that is QIB, and the price at which the shares will be allocated to QIB will be set by book building method. If the company still does not complies with the 2 conditions, it has to refund the entire subscription money to the public. Clear? Yes, people, yes. With this, let's proceed with the next. Next is other conditions. Next is other conditions. People, for example, if Lenskart is going for an IPO, IPO is called as initial public offer. IPO is called as initial public offer, where you are issuing shares to the public for the first time. IPO is issuing shares to the public for the first time. Now, the shares can be equity shares, or it can be convertible debt instruments, that is convertible later into equity shares. Okay, it can be convertible debt instrument, later convertible into equity shares. Basically, they are bonds, debentures, or other type of securities like warrants. Okay, these are convertible into equity shares after 1 year. Until that period of time, it is bond. Okay, let's understand with an example. Convertible debt instrument. For example, people, let's say Lenskart has taken a loan from the bank for rupees 1 lakh rupees. Lenskart has taken a loan from the bank for 1 lakh rupees, whereby Lenskart says that, Lenskart tells the bank that after 1 year, you can convert this loan into equity shares of Lenskart. After 1 year, you can convert the loan of 1 lakh rupees into equity shares of Lenskart. Okay. If one share, if after 1 year, if one share cost rupees 1000 rupees, for 1 lakh rupees, how many shares will be received by the bank? 100 shares will be received by the bank. Okay. If one share cost rupees 1000 rupees after 1 year, for 1 lakh rupees, how many shares will be issued to the bank? 100 shares will be issued to the bank. Until that point of time, until the conversion, it will be a proper loan. But once the bank is eligible to convert the loan into equity, it can convert into equity shares. This is called as convertible debt instruments. Debt instruments like loan, bank, loan, debentures, warrants, convertible into equity shares at a predetermined date and time. Clear? Perfect. So what this rule is saying that companies can issue convertible debt instruments for the first time without issuing equity shares, provided it must not have defaulted on payments in the last 6 months. In the last 6 months, I should not have defaulted in any types of payments. Then only I can issue convertible debt instruments. Clear? Perfect. Number 2 is very simple. Minimum number of allottees should be more than 1000 people. Minimum number of allottees should be more than 1000. Number 3, outstanding convertible debt securities. No IPO if there is outstanding warrants, outstanding convertible debentures, outstanding bonds, or any rights that entitle someone to receive equity shares after IPO. Okay. Basically, if Lenskart is going for an IPO, it needs to ensure that there is no convertible, there is no outstanding convertible debt securities like warrants, convertible debentures or bonds, or any rights that entitles person to receive equity shares after IPO. Clear? Because the reason is, if pre-IPO equity shares, post-IPO equity shares, it will create a lot of confusion, it will create a lot of price differences. Clear? That is the reason why before a company goes for an IPO, there should be no outstanding convertible debt instrument, convertible warrants, convertible bonds, convertible loans. Okay, whatever it is, it has to be converted before Lenskart launches an IPO, so that after IPO all the shareholders are treated equally, all the shareholders have got shares at same price. Clear? No company, if there is outstanding warrants, convertible debt instruments, bonds, or any rights that entitle someone to receive equity shares after IPO. Clear? Good to go, people. Next is monitoring proceeds. For example, if Lenskart's IPO size is more than 100 crores, if Lenskart's IPO size is more than 100 crores, it has to appoint a bank or a private financial institution. It has to appoint a bank or a private financial institution to monitor the utilization of funds, and report quarterly until 95% proceeds are used. Basically, if IPO size exceeds 100 crores, Lenskart has to appoint a bank or a private financial institution, whereby banks or private financial institution will monitor how am I utilizing the IPO proceeds, number 1. Number 2, they have to report to Sebi on quarterly basis how am I utilizing this IPO proceeds until 95% of my proceeds are used. For example, if I am raising 100 crores, until 95 crores are utilized by me, they will be reporting to Sebi on quarterly basis. Clear? Alright, people, alright. Next is IPO grading. Okay, IPO grading. It is basically Lenskart appoints one or more credit rating agencies. Lenskart basically appoints one or more credit rating agencies whereby these people will assess how the IPO will be conducted. Okay, they will find out for what purpose is Lenskart is going for an IPO. Okay, what is the market conditions, every single thing it will take into assessment, and then it will give rating to Lenskart's IPO out of 5 rating. If it is 1, that means IPO is very poor, public should not purchase shares. If it is 4, public should purchase shares. It is a good IPO. If it is 5, then it's a fantastic IPO. Public should purchase shares. There is no risk involved. So basically, to gain the trust and the confidence of the public, what companies do is companies appoint one or more credit rating agencies whereby they will be making a detailed assessment of the IPO so that investors can make informed decisions. Clear? Perfect. 5 other conditions are: if a company is eligible for an IPO, if the company complies with the 4 conditions, while going for an IPO, what are the conditions? Number 1 is it can issue convertible debt instruments provided it has not defaulted on payments in the last 6 months. Okay, good to go. Minimum number of allottees should be more than 1000. Okay, perfect. Next is there should be no outstanding convertible securities like convertible warrants, convertible debentures, bonds or any rights entitling someone to receive equity shares after IPO. Perfect. Next is IPO grading. Lenskart can appoint one or more CRA whereby they will be assessing the quality of IPO in detail so that investors can make more informed decisions. Next is monitoring of proceeds, whereby if IPO exceeds 100 CR, it has to appoint a bank or private financial institution to monitor the utilization of funds until and unless 95% of funds are utilized. Okay, on quarterly basis they will report to Sebi. Clear? Till here we are done with the most difficult topics of raising finance from capital markets. In just 1 hour we are done with the most difficult topics of raising finance from capital markets. Let's quickly cover the remaining topics. Okay, how many topics are remaining? 1, 2, 3, 4. 4 topics are remaining, people. That's it, we are done. Okay, all right. Next is, how will the pricing of shares be done when IPO is done? Okay, during an IPO, how will the shares be priced? Let's find out. If it is equity shares, people, I told you there are 2 types of method of finding out the price. Either it is fixed price, Lenskart is offering 1 lakh shares at rupees 100 each. No confusion, no problem. Number 2 is book building method, where the price is determined based on demand, where the final price is determined based on demand, whereby price range is given. Price range means this is the price range. 100 rupees to 500 rupees is the price range. Okay. Perfect. If it is equity shares, fixed price, pre-decided price, no problem, no confusion. If it is book building, price is determined based on demand, where price range is also given. Good to go. Next is debt instruments. Okay, debt instruments means, I told you, convertible bonds, convertible loans, convertible warrants. Okay, so over here coupon rate and conversion price is mentioned. In convertible debt instruments, coupon rate and conversion price is determined. Coupon rate means, people, interest rate. If I am giving a loan, if HDFC Bank is giving a loan to Lenskart, over here Lenskart has to pay annually or half yearly interest to bank, correct? We all know this. Number 2 is conversion price. Let's say Lenskart tells the bank that after 1 year you can convert 1 lakh rupees into equity shares. You can convert 1 lakh rupees into equity shares. So at what price you have to convert this price debt into equity shares? Okay, what should be the price of the conversion price? What should be the conversion price of this loan? It is basically set by a lead merchant banker. Clear? Debt instruments basically includes, number 1 is coupon rate, that is interest rate. Number 2 is conversion price. At what price will you convert this loan into equity shares? These 2 things are mentioned in the debt instruments and they are set by lead merchant banker. Clear? Perfect. Good to go. Next is issue price versus face value. Over here, very simple. The issue price should always be more than or equal to face value. It should not be less than face value. Very simple. Next is offer document. Basically, people, offer document mentions every single thing about the IPO. Offer document basically mentions every single thing about an IPO. what is the name of the company, what is the IPO size, who are the intermediaries involved, who is the merchant banker, who is the lead merchant banker, who is the underwriter, who is syndicate bank, who is registrar to the issue, who is banker to the issue, who are the promoters, who are the directors, what are the shareholding patterns, what will be the duration of the IPO period, whether it is 4 days, 5 days, 6 days, 7 days. Every single thing about IPO is mentioned in the offer document. Now, offer document also mentions the price. Price can be fixed, or it can be, if it is book building method, it can be price band. Price band means price range. Okay, price range will be mentioned in the offer document. Based on that, investors will bid for the shares. Okay, offer document mentions either fixed price or price band. Now there is one more type of pricing, people. There is one more types of pricing. Over here, people, price is fixed, there is no confusion. But in price band, lower range is mentioned, upper range is mentioned. Lower range is mentioned, upper range is mentioned. But there is a document called, there is an offer document called as red herring prospectus. What? Red herring prospectus, whereby there is no price, there is no price band. There is only the floor price, that is minimum price is mentioned. There is no maximum price limit. That is called as red herring prospectus. Clear? So pricing for equity shares, it can be either fixed price or it can be through book building method. Next is debt instruments. It includes coupon rate, conversion price, issue price should always be more than face value. Perfect. In offer document also it mentions fixed price, price band. If there is no price band, that means it's a red herring prospectus where only floor price, the minimum price is mentioned. Cool, easy to go. Next is differential pricing in IPOs. Differential pricing in IPOs. Okay, let's understand this. People, retail individual investors like you and me, retail individual investors means those investors who make an investment less than or equal to 2 lakh rupees is called as retail individual investors. Okay, retail individual investors are those who make investment at least, okay, who make investment not more than 2 lakh rupees. Okay, perfect. Now what this point is saying is that retail individual investors and employees can be allotted shares at maximum 10% discount. Retail individual investors and employees can be allotted shares but at a maximum 10% discount. They can be given a discount, no problem, but how much discount? Maximum 10% discount is only applicable to them, not more than that. For example, if 100 rupees shares are issued to big players like HDFC Bank, SBI, insurance companies, then I cannot allot to the retail individual investors or employees shares at a price less than 90 rupees, that is 10% discount. Clear? Good to go. Next, anchor investors. Two types of investors are there, anchor investors and retail individual investors. These two people can be given differential pricing. Okay, anchor investors, the price at which I am allotting to anchor investors, the price at which I am allotting to the anchor investors should be always equal to or more than the other applicants. Okay, I cannot offer shares to the anchor investors less than to what I am offering to other applicants. Okay, anchor investors do not deserve a discount. Retail individual investors, employees deserve a discount. Basically, this point is what it is saying. Okay, basically the meaning of anchor investors are given shares before the public. You might think it's injustice. Now let's see. Even though they are offered shares before other applicants, they have to pay the price equal to or more than the other applicants. They cannot be offered shares less than the other applicants. That is the main condition. Now the reason why they are given shares before the public, is to signal confidence, to create initial demand in the market. So people tell me one thing, anchor investors are big players, HDFC Bank, life insurance company, foreign portfolio investors, such big players are called as anchor investors. Now you tell me, if anchor investors is putting in so much amount of money, if anchor investors is putting in so much amount of money in an IPO, obviously he has subscribed to those shares after analyzing every single thing, correct? He has subscribed to those shares after analyzing every single thing. Now if he has subscribed to the shares, obviously it signals confidence in the mind of the small people. Small people means retail individual investors or employees, okay? So it signals confidence. If such a big person is investing in the company, that means it's a really good company. The IPO is worth to be invested. Number 3 is generates initial demand. So when shares are offered to anchor investors before anybody else, he creates an initial demand in the market. He pushes the demand. If he pushes the demand will rise. The demand will rise. Everybody will start purchasing shares of the company. Clear? Basically, anchor means anchoring to generate demand. Clear? Perfect, people. Perfect. Next is promoters' contribution. 1, 2. Promoters' contribution. Okay. So, people, let's say a company is going for an IPO. A company is going for an IPO. There are 2 stages. This is 2024, 2025. Okay. In 2024, the company was not listed, but during 2025, the company got listed. Okay, no problem. Now, before the company got listed, that is pre-IPO, the capital was 100 crore rupees. The total capital, that is pre-issue capital, is 100 crore rupees. Now it launched an IPO for another 100 crore rupees. That means total 200 crore rupees. So before IPO, the pre-issue capital was 100 crores. Post-issue capital was 200 crores. Correct? Life is easy. It launched an IPO for 100 crores. That is the reason why this 200 crores is there. Now, promoters was holding initially 20%. That is 20 CR he was holding in the company. Promoters contribution pre-IPO, promoters holding was 20%. 20% means 20 CR. Good to go. Now after launching IPO, the capital was post-issue capital was 200 crores. Now promoters should contribute at least 20% of the post-issue capital after IPO. Promoters should contribute at least 20% of post-issue capital. Promoters should contribute at least 20% of post-issue capital. That is, they have to contribute 40 CR, correct? Already 20 CR they have contributed. Now another 20 CR they have to contribute. This is what the rule is saying. Promoters should contribute at least 20% of post-issue capital. Clear? Minimum promoters contribution at least 20% of company's post-issue capital. Pre-IPO, total capital was 100 CR. Promoter was holding 20%, 20 CR, no problem. After IPO, the total capital became 400 crores. 400 crores, the total capital became 200 crores. 200 crores, 20% is 40 crore rupees. Promoters had contributed 20 CR. Now the requirement is 40 CR. So additional 20 CR he has to contribute. This is what the rule is saying. Clear? Now that is the lock-in period. Lock-in period means the promoter has invested 20 CR, additional 20 CR in the company. He cannot withdraw that money. Let's find out. The lock-in period is 20% for 3 years. Okay. So the promoter has contributed additional 20 CR in the company. So total 40 CR. Now this 40 CR he cannot touch until 3 years is completed. Promoters cannot touch the 40 CR until and unless the 3 years is completed. Now the 3 years is calculated from commencement of commercial production. For example, Lenskart has raised 100 crores from an IPO for expanding its business, opening 10,000 new stores in India. Now, until and unless it does not start its commercial production, this is called as commercial production, expansion, actual expansion of company, or the date of allotment of shares to the public, whichever is later. For example, if date of commercial production was 1st March, allotment was 1st April, so from this date 3 years will be calculated. Okay, from this date 3 years will be calculated. Yes people, clear? Basically, promoter's contribution is locked in for a period of 3 years from the date of commence from the date of beginning of commercial production, actual expansion, or the date of allotment of shares to the public, whichever is later. From that time, from that date, 3 years, until 3 years he cannot touch his money. Until 3 years he cannot touch his money. Clear? Now for example over here we understood that promoter has to contribute additional 20 CR to make it 40 CR. Now by mistakenly, if promoters, not by mistakenly, the promoters has contributed 50 CR or 60 CR, then the excess, that is more than 20%, should be logged in for a period of 1 year. Requirement for the promoter to contribute is 20 CR. Now he has contributed 30 CR. Now the remaining excess 10 CR is logged in for a period of 1 year. Logged in for a period of 1 year until and unless the Lenskart comes with another IPO. Lenskart comes with another IPO. There is nothing called as another IPO. It is called as FPO. Until and unless Lenskart comes with another public issue, this 1 year he cannot touch. Okay. If Lenskart has contributed additional money, then he can touch the money within 1 year, provided the company launches another public offering. If not, he cannot touch the excess money until and unless of 1 year. Clear? So basically people, lock-in period from, let's revise it again. Promoter's minimum contribution is 20% at least of the post-issue capital. Clear? Very easy. Next is lock-in period. Once promoters has contributed the post-issue capital, how long will the money be locked in? Okay, locked in for a period of 3 years from the date of beginning of the commercial production or date of allotment of shares to the public, whichever is later. From that period, 3 years, he cannot touch the money. Okay, if the promoter has contributed additional money, that is more than 20%, if he has contributed, that money will be locked in for a period of 1 year. Now this period of 1 year has got an exception. The exception is the company comes with another public offering, that is FPO, then this 1 year will not be applicable. Otherwise 1 year will be applicable. Clear? All right people, all right, perfect. The last concept is differential pricing. Last concept is allocation in an IPO. Now we understood how shares are priced. We understood what is the promoter's contribution. We understood the differential pricing. Okay, yes, understood. Next is pricing of shares in public issue for equity shares, for convertible debt instrument, how the pricing is done. Then we understood what are the other conditions Lenskart has to comply with to go for an IPO. What are the main conditions for Lenskart to go for an IPO? Who are the intermediaries? What are their roles and responsibilities? And what are the basic conditions for a company to go for an IPO? This is called as eligibility of issuer. Okay, let's quickly come to the last concept, that is allocation of shares in an IPO. How shares will be allocated in an IPO? Let's understand this. Okay, general book building method. General book building method. Let's say 1 lakh shares the company has issued, 1 lakh shares the company has offered, 1 lakh shares have been allotted. Now what will be the shareholding pattern of those 1 lakh shares? Let's understand it. Okay, so basically people, there are three types of investors. Investors are categorized into three types. Number one is retail individual investors like you and me. Number two is non-institutional investors like Bill Gates, Nikhil Kamath, Warren Buffett. They are all non-institutional investors. Okay. Number three is big players, that is qualified institutional buyers, banks, insurance companies, and public financial institutions, portfolio management companies. They are called as super big players. Mutual funds. Okay. Now let's understand, if all of them want to buy shares, all of them have paid money, how will the shares be allocated? Let's understand that. Okay. This is the last concept. Okay. Quickly. Retail individual investors should be allocated shares at least 35% of the issue. For example, 100 shares are issued, at least 35 shares should be issued to people like you and me. If company is offering 100 shares, at least 35 shares should be given to the public like you and me. Clear? Next. To people like Nikhil Kamath, Bill Gates, Warren Buffett, how many shares will be given out of 100? Maximum, okay, minimum 15% of shares should be, 15 shares should be given to Bill Gates, Warren Buffett, Nikhil Kamath. Clear? Are you able to understand, people? Are you with me? All right. So, if 100 shares company is offering, at least 35 shares should be given to retail individual investors like you and me. At least 15 shares should be given to non-institutional investors like Nikhil Kamath, Warren Buffett, and Bill Gates. And last is maximum 50 shares can be given to qualified institutional buyers. Over here it is at least. Over here it is maximum. That means you cannot exceed 50 shares when you are offering. If you are offering 100 shares, you cannot exceed 50 shares when you are allocating to qualified institutional buyers. Okay. In this case, you can exceed. You can give 16 shares, you can give 20 shares, you can give 30 shares. Over here, you can give 40 shares, 50 shares. But you cannot give shares less than 35. You cannot give shares less than 15. But over here, it is maximum of 50%, which means you cannot cross the 50 shares criteria. So, qualified institutional buyers include mutual funds, insurance companies, etc. Now, among these 50%, 5% should be, at least 5% should be given to mutual funds. Now, over here also categorization. Okay. The 50% share that you are given to QIB, at least 5% of shares should be given to mutual funds. Okay, should be given to mutual funds at least, but not more than 30% should be given to anchor investors. Okay, basically people, anchor investors is not mandatory. Okay, basically anchor investors are not mandatory. Remaining 45% shares can be given to anybody else who are qualified institutional buyers. 45% shares can be given to anybody else provided they are qualified institutional buyers. Okay, but anchor investors can also get shares, but maximum of 60% of QIB. Maximum of 60% of QIB. That is also optional. Okay, that is optional, completely optional. 60% of QIB means 60% of 50%, correct? 60% 50% is not more than 30% should be given to anchor investor. That is also optional. If I am offering 100 shares, you can give it to anchor investors, you cannot give it to anchor investors, it is my choice. But if I give to anchor investors, not more than 30 shares I can give to anchor investors. Okay, cool. Let's quickly revise it again. Retail individual investors, not less than 35% shares. If non-institutional investors, not less than 15% of shares. If it is QIB, maximum of 50% of shares I can allot. Okay, among those QIB, at least 5% of shares given to QIB I have to give to mutual funds. That is mandatory. Remaining you allot to anybody else provided they are also QIB. But you can also give to anchor investors. But again, anchor investors cannot be given shares more than 30%. which means 60 anchor investors cannot be allotted shares more than 60% of QIB. Clear? Perfect. Perfect. This is the mind map. More concise mind map is this. Yes, people. Yes. Next is special case. Let's say there is too much demand from the retail individual investors compared to qualified institutional buyers, or let's say there is more demand from the side of qualified institutional buyers compared to retail individual investors. We will consider if there is more demand from the qualified institutional buyers. If there is more demand from the qualified institutional buyers, how will the shares be allocated? Okay. Retail individual investors cannot be given shares more than 10%. If there is a lot of demand from the qualified institutional buyers, retail individual investors cannot be given shares more than 10%. Okay. In the same way, non-institutional investors cannot be given shares more than 15%. Okay. Over here it was at least 15%. Over here it is more than. Okay. So, retail individual investors cannot be given shares more than 10%. Non-institutional investors cannot be given shares more than 15%. Qualified institutional buyers can be given shares more than 75%. Qualified institutional buyers can be given shares more than 75%. Among those 75%, at least 5% should be given to mutual funds. That is unchanged. There is no change in that. Again, people, 60% of QIB can be given to anchor investors. Same thing, 45%. Clear? But this time, if qualified institutional buyers are getting shares of 75%, which means anchor investors can get shares 60% of QIB, 60% of 75% is 45%. Again, it's not mandatory. Okay, if they want to give to anchor investors, they can give, but they should not be given shares more than 60% of QIB. Clear? Perfect. This is the mind map. Basically, special case are those when there is too much demand for the shares from the big players. Okay, big players. Cool. Last concept is if price is determined based on fixed price. Okay, how will the shares be allocated? If price is determined based on fixed price, how will the shares be allocated? At least 30% should be given to retail individual investors. Okay, at least 30% should be given to retail individual investors. Supposing if 20% of retail individual investors have only subscribed for, if 20% of retail individual investors have only subscribed, remaining 10% have not subscribed, then what will we do with the 10%? We will allot those unsubscribed portion to either non-institutional investors or qualified institutional buyers. We will either allot shares to non-institutional investors or qualified institutional buyers. Clear? Now, supposing if there is unsubscribed portion from the side of QIB or non-institutional investors, then the remaining portion will be given to retail individual investors. Very simple, very simple. Cool. This is called as non-book building process. People, we are done with the chapter. Look how quickly we are done with the reading part, understanding part, learning part. Don't you think how amazing it is using this mind map? This is the power of mind map. This will improve your quality and speed of learning by literally 10 times. You won't feel burdened. Okay. This is the power of mind map, people. This is how I am going to teach you. Did I look at the text, people? Did I look at any concept? No. Whatever I did, I looked only on the mind maps. This is the power of mind maps, people. People, one thing I will tell you. I forgot to explain you one thing. Over here, I mentioned as selling shareholder. What is the meaning of selling shareholder? Selling shareholder is this person. Selling shareholder is this person, whereby Reliance Industries has got 3 shareholders: Mukesh Ambani, Anant Ambani, Bill Gates. Bill Gates is selling his shares to the public, so Bill Gates is a selling shareholder. Okay, so if a company issuer, promoter, director, or the selling shareholder, the shareholder of my company who is selling his shares to the public, he should not be debarred by SEBI or not be involved with companies debarred by SEBI from accessing the capital market. This is the point I was trying to tell you. Okay. All right, people. We are done with the eligibility of an issuer. We are done with the intermediaries part. We are done with the appointment of intermediaries part. We are done with the conditions for an IPO. We are done with the pricing of shares. We are done with the promoter's contribution. We are done with the allocation of shares in an IPO. We are done with the first chapter of SEBI regulations. Clear? This is how we are going to study every single chapter in using mind maps. Quickly, time efficient manner, in the best possible manner. Okay. All right, people. All right. If you have got any doubts, please immediately drop your doubts in the YouTube comment section. As soon as I see your doubt, immediately I will solve your doubt. Okay. Otherwise, you have my WhatsApp number. Okay. 749905455. This is my WhatsApp number. If you want to put your doubts in my WhatsApp number, please drop me a WhatsApp message and I will be super happy to solve your doubts. Okay. All right, people. All right. Please, if you found this video useful, please share it with someone who may need it. And that's all from my side. Thank you so much for watching. I will see you in the next one.